I'm Shannon Richards. I'm the current president of MEREDA. I'm joined by Nova Tower of Waypoint Brokers Collective and Britt Vitalius of Vitalius Real Estate Group. Nova's going to kick things off for us with a presentation of the Southern Maine residential and condo market. Britt's going to follow her presentation with a look at the multifamily residential market here. We will try to take a few questions at the end if there's time, and the key to that part of the programming is we need to ask anyone who asks a question to be short, specific, market-related questions. No grabbing the mic to opine about something you've been thinking about. We can do that over a beer later. All right, Nova, get into it.
All right. So I'm going to start today by telling you where we're going to land with the conclusion by the end of this. When we look back at 2025, there was a lot of talk of a market that was possibly teetering on the edge, maybe heading towards decline. People were talking a lot about price dropping, seeing an increase in price dropping, properties that weren't selling, longer days on market. But at the same time, we were also seeing conflicting metrics like rising prices and relatively quick absorption rates and a lot of multiple offer situations. So it's no wonder with all these sort of contradictory messages out there that 2025, the theme seemed to be confusion among consumers and a lot of mixed messaging in the headlines. So that's what we're going to address today. When we look at 2025 data, we are going to seed it in a little bit more of historical context so we can get a better idea of what was going on in the market. By the end of this, you're going to agree with me that 2025 was not falling off a cliff, and we're not headed off a cliff in 2026. Instead, we are experiencing a year-over-year gradual cooling, a very necessary cooling from an overheated blip. And 2025, if I had to sum it up, would be the market of increasing stability and better balance between buyers and sellers. There we go. So I'm sorry, everyone's sick of the word pandemic, but tough. It's the best way to describe these periods. These are the periods. This is just some definitions for us as we get going. Spoiler alert, the biggest difference we're going to find between pre and post-pandemic is going to be around pricing inflation and inventory. So let's start with pricing inflation. So you know how they say Maine is the oldest state in the country and sometimes least racially diverse? We can now also say that we topped the charts nationally for pricing inflation since 2020. So we are at the very, very top, 80.1% pricing growth since 2020. Now, 80% is not normal in 5 years. It took several years of double-digit growth to get us there during the pandemic. Happy to say in 2025, we are down to something way more sustainable. Year over year, if you average it over decades, real estate should appreciate about 4.5 to 5%. And in 2025, we saw 3.85% statewide, so just a little below that annual average. And if we go, let's see. If we break it out by county, you can see some of the highlights there. So Androscoggin and Oxford County topped the chart at nearly 8%. Franklin, Knox, and Sagadahoc were actually experiencing negative price growth, which is not really a cause for super alarm. That's pretty normal pre-pandemic to see that. Cumberland and York County were right there on the average. And for the rest of the slides today, that's actually where we're going to focus our attention, is on Southern Maine. So here we have the median sales price from 2017 to 2025. And you can see pre-pandemic, we had this nice, gradual, reasonable growth. And things got a little out of hand there for a while, very unsustainable. And now, by 2025, we've really come back to a less steep line, something more reasonable. And condos in that red line you can see at the bottom there, condos actually leveled off from 2024. So also really interesting, just to point this out, we just talked about 80% growth in 5 years, but if you notice, if you were in Southern Maine and you bought a house in 2017 and you kept on top of maintenance and cosmetics, your house might be worth roughly 208% of your purchase price. So if you're interested in cashing out that equity, please call us to list it and help us solve our inventory problem, which we're going to talk about in a moment. So here was the highest price sale in 2025. It was in Cape Elizabeth for $13.4 million. It's the third highest in MLS history. Of the 5 highest sales in 2025, 4 of the 5 were in Southern Maine. 1 was in Bar Harbor. And Skipping ahead. So here's our inventory problem, right in your face. So if you look at those bars there, that represents single family homes. That line down at the bottom is condos. And if you look at 2023, which is the first light blue, it's the lowest bar there, that's about 40% of listing volume from pre-pandemic norms. The good news, as you can see, is that we're coming back up. Things looked a lot better in 2025. We're still hurting for inventory, but it's definitely trending in the right direction. Condos, you can see, it looks relatively flat, but if you look closely enough, you can see there that there has been some growth, and it's actually the opposite. So we actually have more condo listings in 2025 than we had pre-pandemic. So this slide is showing us, that top dark blue line is showing you all the new listings in that year on the MLS. The red line is all the sold listings. And what's interesting about this one is the delta between the two. So it's showing you how many of the new listings in that year are being sold. And when you see that nice wide delta pre-pandemic, the way you should be thinking about that, that's buyer choice, right? Like that's buyer leverage. Then you can see very clearly the compression that we experienced during the pandemic. The thing I'd like to point out about that is I think everyone thinks the pandemic compression was more about the market being flooded with buyers for those low rates. But actually you can see when you look at this slide, the compression really happened, it was driven more by a decrease in listing volume. 2022, we just took a nosedive when rates and inflation went up and a lot of buyers and sellers left the marketplace. By 2025, things are starting to look better. That delta is widening up again. Listing volume is increasing, not quite wide enough. So we still have, what looks like greater sellers leverage there, but getting closer. So here we have the same thing, but for condos, totally different pattern. Condos have always, pre-pandemic and post have had that wider delta. And again, things in 2025 for condos are looking very balanced between buyers and sellers. I will point out, interestingly here, the condo compression that happened during the pandemic is the opposite of single families, where it really was driven by a flood of buyers in the marketplace. Personal opinion, I think right there you're seeing the out-of-state buyers coming from major metros and flooding the condo market. So this is the same data, but expressed differently, and I promise it's not redundant. There's a point to this madness. So I want to talk about the single families, which are the bars on this chart. So this is the sold listings to new listings, but expressed as a ratio. And what this chart to me says is it is a statistical view of buyer sensitivity to property flaws. So during the pandemic, 91% there, you can see 91% of listings were selling. Buyers would buy anything. Like, it did not matter if the property had flaws or not. And here now in 2025, you can see we're down to 79% of listings are selling, which looks a whole lot like pre-pandemic benchmarks. And that is buyers being careful again. So they are no longer is the goal to just buy a property. The goal is to buy the right property under the right terms, which is both those things are really important. So here we have median list price to sales price ratio, another really important ratio in sales metrics. 2025, looking pretty balanced. So we are at 100% list price to sales price ratio for both single family homes and condos. Condos, you can see, have been more consistent over time. When you think about that chart I showed you where you could see that nice big delta between supply and demand, here's how this shows up in less aggressive buyer behavior. Median days on market. So I broke out new construction for this one. Those dashed lines represent new construction. If you are a builder in the room, don't panic. Not a terrible sign that new construction takes a little bit more days on market to sell for a lot of reasons that we don't really have time to discuss today. It should take new construction a little bit longer to sell. In my opinion, most of that has to do with listing presentation and strategy. We'll talk a little bit down the line about new construction a little bit more, but the thing I want to take away here for 2025, for single family homes, we're 11 days on market. And yes, that is increasing from our pandemic low, but if you look, that is still well below our pre-pandemic benchmarks and still is a very fast-paced market that to me predicts really strong seller outcomes. At the same time, it gives buyers a little bit more time to think than they experienced during the craziness of the pandemic. So So this is my favorite slide, but let me anchor you in what the heck you're looking at here. So this is a heat map that is an absorption rate expressed as months of supply. If you look at the upper section from left to right, that is the pre-pandemic period from January to December. And this is basically showing you how fast units are moving off the market. Then we get into that blob of sort of just homogeneous dark blue. And that is the pandemic period. And then at the bottom, we're into more recent years. The darker that blue is, the faster the market is moving, the more seller leverage there is. When you get into the reds, you have more buyer advantage. That's where you have about 6 months of supply. And anywhere 3 to 6 months is considered a pretty balanced market between buyers and sellers. So right here you can see in 2025, we sort of lost, because the other thing I love about this is a really beautiful visual of seasonality in the residential marketplace. And during the pandemic, we really lost it entirely. Pre-pandemic, we had this really nice, buyer and seller leverage would sort of dance around based on seasonality, and we lost that entirely. And now by 2025, you can start to see some variation again. It's not so homogeneous. So we're starting to come back to some of our healthier, normal seasonality patterns and a little bit more diversity in our absorption rates. So here we have the same thing, but for condos. And really, I could describe it with the same pattern, except that condos have a little less volatility, a little bit more balance for buyers and sellers throughout. Oh, it's just if you like to compare them. So market stress indicators, we're going to look first at expired and terminated rates. There's not much to say about terminated rates. It's pretty flat. Not that interesting, but we'll look at expired rates. And what you can see here is, yes, expired listings are on the rise, but we still have a long way to go before we get to what I would describe as sort of normal market behavior, where you have about a quarter of listings expiring. It doesn't mean they didn't sell. They might have come back on the market and sold at some point, but we do see that expired rate is increasing. The median price of expired listings in 2025 was $729, which is quite a bit more than the median of sold transactions, which was about 200,000 less. So it tells you about where buyer mentality is on price these days. So here we have price changes and back on the market data. So this one is really interesting to me. So price changes, price drops, I felt like people really cited as like the reason they thought the market was about to collapse, because all of a sudden they're seeing all these price drops and they hadn't seen that for a while. But price dropping is a very normal market behavior. And 25 to 30% of properties experience a price change, totally normal. We are still below that in 2025, but getting close. The back on the market data to me is really interesting because it was surprising to see 2025 at such a low for that. We kind of, during the pandemic, lost track of, inspections weren't really happening. Appraisal waivers were happening left and right. Withdrawn listings had dropped really low. Those are all the reasons that a property would come back on the market. So you would have expected the pandemic to be the all-time low on back on the market data. And that's not what we're seeing. We're seeing, for more like 2025, is having even lower rates of back on the market. To me, this is again confirmation of that buyer carefulness. People are being more careful about the offers they're making. And I think that means they're happier with their offers and more willing to stay in the contract if things get a little rocky. This is a breakdown of sales metrics by age of construction. This slide is a lot to look at, so we're actually going to skip it. I wanted you to have it, but what I've done is I've created us a cheat sheet instead. So this is sort of a summary of that data. It's a little easier to grab. I put this in here for the builders in the room. What you're seeing here is performance based on age of build. And the thing that's interesting and the takeaway here is that the top two spots are taken by what I'll describe as newer construction. And the bottom two spots are taken by what I would describe as newest construction. And so the interesting thing to ask is, why is the newest construction performing more poorly? Again, it's a sort of a don't panic situation, because I think this is a little bit more anecdotal now, so you're gonna have to take my word on it and feel free to disagree with me over that beer later. But my feeling about this is it has so much more to do with listing strategy and presentation than anything else. Cost of construction, we just saw from the guys in the construction outlook, has really gone way up. And it's really hard to build character into new construction these days, but character is a really big part of what makes sales successful. And I think that is really the thing that is the difference between the older construction and the newest construction and why it's struggling to sell. I think there's a lot of creative solutions to this that builders can use. I'm a little biased, but I think the biggest one is connect with your listing agent way earlier in your process, before you're penciling the project, to figure out how to get around the sales objectives that are putting newest construction down there in the bottom. So here we have, speaking of new construction, price inflation. That was so interesting in the Construction Outlook when they put that data up there about how in 2025, for anyone who wasn't in the room, in 2025, the price per square foot to build was around $300 a foot. That did not include site costs. And yet, in 2025, we have the median price per square foot sold at $351. So this is a real challenge. And on the front here, this looks like a nice healthy growth, 80.9% since 2017. But when you have the cost of construction, basically keeping pace or matching this growth, it has implications for affordable housing and housing stock. Again, I don't have the solution. Luckily, I'm not the builder. I just have to sell it afterwards. But I do think that there is room for creativity here to get that 351 up. I think it takes a lot of creativity on the listing strategy to get there. So I'm going to skip this in the interest of time. It's just a summary of everything I've just said, and I really want to get into the forecasting. So before we can get there, I just need a little more historic context. This is a line chart showing the pace of price changing since 1950. So if you find that zero, let your eye find that zero line there. When I go to a dinner party and people find out I'm a realtor, everybody asks me these days, this was 2025, everybody wanted to know, oh my God, is pricing gonna bottom out? Should I sell now? Should I wait to buy? And this is what I refer to when people ask me that question. So if you look at that zero line, there's only 2 points in history where you can see any kind of significant dip below zero, representing price decline, so negative price growth. Otherwise, what you see during different periods of downward market movement, you're still seeing price growth. It's just at a slower pace. And I think it's really fascinating that the 2 periods where we actually ever saw negative price growth were tied to recessions that had uniquely to do with bad loans. So in the earlier case in 1990, it was banks not giving them out enough, along with a whole bunch of other things going on at the time, but banks not giving out enough loans. And then in 2008, we had too many loans going out to people who shouldn't have had them. So it takes extraordinary economic conditions, usually tied to mortgages, to actually see home prices decrease and slide backwards. And this is national data. I think it does bear talking about that Maine tends to be more resilient than national data. So here we have that. The blue line represents Maine, the green is New England, and the red is the United States from 2008 to present. And you can see we were more resilient to price decline in 2008, and then we held our own all along, and then we outperformed price growth in the pandemic. So Maine holds up pretty well. And ultimately, to me, when I look at those two charts combined, what I would say is we always talk about real estate markets being cyclical, and they are. But the cycles are more of an ebb and flowing, at least with regards to pricing. It's more of an ebb and flowing to the rate of price growth. It's pretty rare to see the pricing sort of backslide like that. It's also, I think, the cyclical part of it is the changing in buyer and seller leverage and dynamics there. So I would say right now we're, ebbing back from a very intense pandemic flow. So there you have it. There's my summary again of the differences of these particular periods. The most important thing to know in 2025 is I think we're in a place where we're normalizing. I don't think we're quite normal yet, which brings us to the beyond part of that. And here is my prediction for the beyond. So I think that we're going to continue ebbing. I don't think we're done ebbing. I think we're going to be moving towards a healthier, more balanced marketplace. I think with every year we get away from the 2.5 rates, inventory will increase, and that will increase the months of supply, which will even the playing field. Median price, I do think we're going to keep, I think prices are going to keep rising. I think we're going to stay below that 4.5 to 5% annual average for a little bit longer. And I think all the other metrics are going to level out as well. I don't think we're going to see any steep declining or steep rising in the next year or two. Same thing for list price to sales price ratio. And seasonality. I think the only thing that could really disrupt seasonality is if we see dramatic changes to rates with, spurring on some pent-up supply and demand. Otherwise, I think seasonality is on its way back. So I think that's it for me. These were just some sort of cultural and social things. Maybe we have time for this in the conversation later. I think the most interesting one is the median age of first-time homebuyers is now over 40, which is wild. The younger generations are really following a rent, don't buy mentality. So that's it. Yeah.
Thanks, Nova. That was great. Ready for multifamily? That was a lot. That was awesome. Great job, Nova. All right, so now we're going to talk about multifamily, which is sort of a cousin to residential. In the multifamily world, there's a rental market, there's the owner-occupant market, and there's the commercial aspect of multifamilies. I'm not going to do quite as much data, try and keep things a little higher level, not really a lot of dramatic changes. So starting out with sort of the national picture of the rental market, it's seeming to cool, that generally speaking, supply is up. And so that's part of the solution to our housing challenges, our housing crisis. Demand from the renters is mixed. I've heard locally and read nationally that the slow job market is having an effect on rental demand. But at the same time, like Nova's, I think, last slide just showed, that people are choosing to stay renters and not buying. And it's hard to be a first-time buyer right now. So we've got different forces affecting rental pressure, but certainly across the board nationally and locally, we're seeing supply up. And the result is pretty modest rent increases. It's really mellowing out to, I think, some of the lowest rates we've seen in a long time. So locally, my phrase is the market's settling in. I think yours was cautious buyers, careful buyers, careful buyers. I'd say the market just feels like it's settling in, and the data is going to show that. Both the sales and the rental market are flattening. And with that happening, the buyers are sort of saying, well, where's the upside? If I can't just swap out a unit and put in granite countertops and stainless appliances and double the rent, where do I go? Do I have to actually work for this money? Just being snarky there, sorry. So let's look at the activity. There's a number of transactions, and my data is going to be looking at Portland, Saco Biddeford, and Lewiston Auburn, the three major metros in southern Maine where there are multifamilies, a sizable number of multifamilies to get data from. So in the middle, you see the that dark blue line, and then the green. That was 21 and 22, sort of peak COVID, a lot of activity. In 21, started settling back in 22 in the green line, and then all metros really dropped down after that. And I guess what I was surprised to see is that Portland's actually climbing back up and becoming more active. And I'm going to talk about Portland's rent control again, unfortunately, but in part because of that, I'm surprised to see the activity increasing. Saco and Biddeford, on the other hand, was down quite a bit, and this is going to be really one of my stories today, is the change of sales and pricing down in Saco Biddeford. And likewise, Lewiston Auburn, which has been a very active market and with a ton of growth, also is settling back in terms of some of the activity. And is that reflected in the pricing? Well, Portland's up a little bit, and this is going to my sort of settling out theme. It's really kind of flat. 3% increase is basically flat. Saco and Biddeford is actually down 5%, and we could feel that on the ground in real time over this past year. And Lewiston Auburn, I got to look this way because my timer's in front of my slide here, is up just a little bit at 5%. So again, pretty flat, maybe up a little, down a little bit, but prices have certainly leveled over the last year. Nova touched on some of this metric too. This is a different way of looking at the data. How many listings are not selling? And I did this a year ago because we could really feel it in Portland. And all of a sudden, we hit one fall. And it's like, things just were not selling. We're pulling them off the market. We said, I think we got the pricing right. We just need to wait. The buyers just aren't there. Let's pull them off. So Portland's now returning a little more normal, a little healthier. And so here those red arrows down show sort of better activity, that fewer properties are not selling, if I can say it in a really convoluted way. But in Saco and Biddeford, look, 130% increase of listings that never sold and either expired or withdrawn or were canceled from the listing. So again, a dramatic change in the Saco Biddeford market. This is just another view of sort of price distribution across the different counties. It's not really new information, but it's just fun to see how Lewiston Auburn sort of that left curve, and Saco and Biddeford is the middle, and Cumberland County is the right, but sort of how the sales are distributed over the pricing. So let's talk a little bit about Portland. Now, you can't talk about Portland, the multifamily market, without talking about rent control. And what's important to know is that if you are owner-occupied in a 2, 3, or 4 unit building in Portland, then the rent control restrictions don't apply to those other units while you're living in the building. That's significant. They also don't apply if you lease your unit to someone who receives a subsidy, Section 8, general assistance, or other programs. So that's an important backdrop to know because this is a big factor in the market in Portland. Otherwise, you are stuck with the rent you've got and can only take very modest increases. It doesn't matter if the tenant turns over. It doesn't matter if the building sells. You've got the rent you've got, and that's going to be it. So the 2 to 4 units are up slightly, and we're going to see that, but really they are only purchased by the owner occupants. 5 units segregate into 2 markets, and as I just mentioned, the value add in that market can really only be achieved by renting to someone who receives a subsidy. You can't go in and just make the unit nicer and get a higher rent. Those days are gone in Portland. So let's look at some of this data where we see this. So 2 units are up a little, 3 units are up a little. These are Portland, the smaller units. 4 units are down a little. Again, this is a wash. This is basically, it's flat in Portland, and I can promise you that there was no property that we went to see in 2025 that we thought was worth any more than it was worth in 2024. The market was basically flat. So can we explain these differences a little bit? Well, if we look at properties that sold, multi-units that sold in Portland, over $1 million, we've sort of had the sense that maybe it's the upper end that's changing. Maybe the upper end is going up, and it's not really. What's changing is those numbers in the middle of the bars are the numbers of transactions of multifamilies over $1 million. And so back in 2019, there was only 1. 2 years ago, there was 22, and last year there was 33. So there's a big change. There's still a very healthy high-end market in multifamilies in Portland, and I think probably the number of sales at this price point is what's pulling those median prices up. It's not that the property went up in value from one year to the next. It's just that there are more properties selling at the high end. This should support my point to say these upper end prices aren't really changing either. The last 3 years, that's a price per square foot, $313, $334, $342. Prices aren't really changing, but there's still a lot of money at the high end. People do still want to live in Portland. People have the money. They want a nice property in Portland. That's still a very active market. So looking at the commercial market, now this is 5+. These are not the owner occupants. These are folks who are going to try and make money off their properties. There just weren't many sales this past year. So I've got some data, and then I'm going to tell you why it's not really right. Because it looks like the price per unit, so the price per unit, the median price per unit went up to $175,000. So, well, why are prices going up? You got rent control, there's no upside, what's going on? Price per square foot seemed to go up too. When we look at the distribution of these 7 sales, I really see them in 2 different buckets. The left side, the lower bars, are, I would say, cash flow properties, normal cash flow properties. These are local owners who are going to work it, are going to manage these buildings and live off the income. These are NOI based. The top 3 are at a very different price point. These are beautiful properties that someone's probably trying to diversify their portfolio, maybe take money out of the stock market and buy it with cash, maybe do a 1031, and they just want to hold a nice asset. They're much less income concern, and so much lower cap rates there. And so they really break into those two different buckets. And these two properties are an example of that. We sold a 12 unit for about $175,000 a unit, and then we sold an 8 unit for $285,000 a unit. Both last year, both in Portland, but very different properties purchased for very different reasons. Okay, quickly touching on Lewiston and Auburn. Still going up, still a healthy market, but definitely slowing down. If folks were here last year for this talk, I had like that hockey stick graph that showed Lewiston and Auburn going up 150% over the last 5 years. Just totally bananas. Obviously not sustainable, seems to be leveling out there. Likewise on the commercial side up there, same thing. Cap rates, I think we got about 8.5 to 11% Lewiston Auburn from what we're hearing. Saco and Biddeford, last couple of slides. All prices are down. 2, 3, and 4 units are all down a little bit. And again, we could feel this. We listed a multi-unit down there last spring, had a bunch of offers, great price, sold it quickly. Just a couple months later, we've listed another very similar property, and it was like crickets. So what the hell just happened? And now, having run the data at the end of the year, you could feel a change. I think there's a change in the rental market down there. There's a lot of inventory. There are vacancies in the winter. Also true in Portland, also true in Lewiston Auburn, but I think more dramatic down in Saco, Biddeford. So they're not in trouble. They're just settling in, and I think that's okay. It's still healthy. They're doing fine. And likewise, those numbers are reflected and look the same in their commercial investor market too. So for 2026, I think we're going to have a flat market. I think we're going to see more commercial activity in Portland. I think some of these long-term landlords are tired of rent control. They know prices aren't going up anymore. So if you're done, you're done. And so I think there's going to be some more inventory available to buyers, which may affect the pricing. Lewiston will probably follow Biddeford and continue its slowdown. And other than that, we're just going to be watching really macro forces, interest rates, wars, all the fun things outside of our control in terms of what affects our market. So, thanks very much. I think we'll now have a couple questions from Shannon to kick us off.
Excellent. Thank you, guys. Amazing how much work goes into pulling this data together. I know you are all doing it on your own, but it's nice to have a presenter who's willing to really dig in and put it in front of us. So looking for the through line first, can you just restate, Nova, you first, what is your conclusion for 2025, if you could really boil it down, 2025 and a prediction going forward, and then Britt?
Yeah, I mean, my high-level summary would be that 2025, I think the buzzword in the media last year was uncertainty in the market. That was like a frequent, if you do like an AI scrub of media headlines in 2025 about real estate, that's going to be like the top bullet point, that and affordability. And I think it's the wrong word. I think ready buyers were very, very certain. In fact, almost more certain if you look at the back on the market data. I just think that really what it is carefulness. That's my word. It's a clunky word. I don't know if someone has a better synonym for me out there, I'd take it. But I think that's what 2025 was about, is it, as we're coming back into better balance between buyers and sellers, buyers have the luxury of being careful again. And I think that that's what we're going to continue to see. And really, when we eliminate the pandemic blip, we see that our market is coming back into some normalcy, some stability.
Thanks.
Yeah, I think I'd add on to that, and hadn't thought about this word, but as I'm reflecting back on the year, buyers were more careful. I think we were joking for a while that, we were joking in that sort of sad and you're crying sort of way of joking, that we had to sell every property twice. That very different from 21 and 22, where they would just, hand you a check, no inspection, see you at the closing, and boy, on the selling side, life was a little too easy. And now it's like, oh, it's under contract. I don't know, we changed our mind. We did an inspection, we don't like it, we're worried. And I think we had a whole run of properties that we had to sell twice. Now, we sold them and even maybe got to that same price, but it was harder. And so I think the word that's coming up in my mind is they're careful, but also there's got to be value. And I think there wasn't really a concern about that during the pandemic. It was just, get me into anything. It's all going up in value, or I just need a home. I'm getting out of Brooklyn, whatever it was. And today it's like, okay, rates are not going down. We're not going to just refi it next year and make all the problems go away. Insurance is going up. Like, it's hard. It's hard to operate this. And so they're really looking closely and really making sure that they want to own what they want to own. So I think that's part of the settling in. And it's healthy. I mean, it's back to a normal market.
Yeah, so I'm just going to say what I've heard every single presenter that I've heard today say is stability, back to finding that balance. I've heard like all these references to the same thing. It was the Steve Weichel that even talking about AI, it's helping us find stability. The presenter from TD Bank talking about the M&A and financing, that was stability. So I think what I'm hearing is that 2026 is heading into a more stable way, but although we still know that we need to build more houses. If you had to choose, would you want to be on the buy side or sell side today?
Are we saying like imagine ourselves as the
Just
consumer
pick.
or
Just
as
go,
a real
quick.
estate professional?
Pull the gun out. Take a shot.
I would say I am on the sell side in Portland. I'm sick of Portland. It's a very hard environment to operate in, and I think we're going to see other sellers saying if there is no more upside, the enforcement of rent control this last year has gotten brutal. And if you folks don't know what's going on, I mean, they are rolling back rents 5 years. They're charging tens of thousands of dollars to landlords, and nothing's changing the ordinance. It's just changing the enforcement. So we're in a very unstable environment in Portland, and that's made it frustrating. So as a multi-unit owner in Portland, it's frustrating. Now, that said, there's still people buying. You can still make a good living. People are still wanting to move here and live in buildings, and I certainly encourage that. But you've really got to want to be involved in the market. But I think there are opportunities on both sides now across the market.
Got to pick.
I'm going to say that what the data shows for single family homes, at least, is that we are still in a market that actually leans ever so slightly seller's market. And so in that way, strictly speaking, the advantages to sellers right now still. I think on the buy side, the number one challenge, and to your last question about healthier market, that we're coming into a healthier market, a more stable market, the one thing that's missing and that we're not coming into, we're not on track for, is affordability, is correcting the affordability crisis that came out of the pandemic. And so in that way, being a buyer, I'm not like jealous of buyers in the marketplace right now for that reason, but I think the buyers who are in the marketplace can afford what's out there. That's why they're shopping. But there's a lot of buyers who are absent, who would like to be in the marketplace, but can't be because they can't afford it, particularly among younger generations. And that's a problem.
Yep, and I think that's what I'm trying to get to here is I think it's still a seller's market. I think particularly new buyers are struggling. And my experience as a buyer, first-time buyer, I was in a nice rental. My then husband was at sea. We had a little kiddo. I really liked renting. Everything was included. But I got kind of forced into, I improved my rental too much. And the landlord was like, this is sweet, I'm selling it. And so I had to buy. But what I could afford to buy at the time was much less of a place than I could afford to rent. I think that's probably a pretty common story. So, but now it seems like it's way harder. We're seeing the average age over 40. Is that just Maine, or was that, I meant to ask you that.
That's a fact. I think that happened in 2025.
Was that United States wide, or was
Yes.
that, yeah, state, so. So what would you tell a first-time home buyer right now?
I would say don't be afraid of getting your hands dirty. I think it's still on the sell side, at least in multis, the properties we have the hardest time selling are the ones that need some work. Mm-hmm. And 20 years ago when I started in Portland, everything needed work. And now people coming to Portland aren't coming to Portland because a property needs work. They're coming to Portland because you go out and get a nice meal and live in a fancy place and live in this beautiful city. So I think there is still an opportunity if you are willing to work. And that just doesn't seem to be part of the appetite of most buyers in the greater Portland area right now.
I think the biggest piece of advice I would give first-time home buyers is to adjust your expectation of how to leverage your first home. I think I'm 41, now you all know. So I'm the generation that grew up being told, you buy real estate, you hold real estate, and you live there for a while, and then you sell it, and that it's the greatest wealth building tool available to us. But that's not really the messaging that the younger generations are being given right now. But I still find that most first-time home buyers, they still hold, the one thing they still hold on to is this notion that they have to buy a house that's going to suit their lives today and their lives in 10 years and their lives in 20 years. They want to have everything fit in one. And I think that's, if you want to buy a house today and you're a first-time home buyer, focus on what does my life look like for the next 3 to 5 years, and does this house fit it? Because if you're trying to buy the house that's, let's say you're like single or you're newly coupled up and thinking about having children down the line, and you're like, let's get the 4-bedroom, 2,500 square foot, 2.5 bath with a finished basement and a half-acre fenced-in yard for the dog we don't have yet. Don't do that because you can't afford it right now. And instead, use it as a wealth building tool that it's intended to be. Buy the starter home, hold on to it, sell out, get the equity, and size up.
So what about the number of people under 41 who know how to use a hammer and a saw? Do you think that's affecting the wanting to take on? I mean, it's expensive to pay somebody to do it. When I think coming up the ranks, people maybe knew how to work with their hands a little bit more. So maybe if you're finding a property that's under distress or has deferred maintenance, they're probably not willing to take it on as much. Are you seeing that, Britt? I mean, the multifamilies are old.
Multifamilies are old. They need a lot of work. I think those folks have always done great investing in real estate because they've got skills, they've got their time, they can invest in their future, in the asset they bought, and not have to pay retail for contractors. We all know how expensive a plumber and electrician are today and how hard it is to even get them to show up. And if you've got skills, then you should be investing in, and I think that's a great opportunity. It always has been. I'm not sure that part's different. We're just feel like we see less of it out there. And my concern is that as the market flattens, everyone wants to be part of the ride when the market's going up. And once it flattens and it doesn't seem like prices it's going to be worth more next year and the year after, then you lose some of that energy to invest. Then you really have to be a long-term perspective. And we've, good and bad, been in a climate for the last, really since 2012 to some degree, where you could hold a property for a couple of years and flip it and do okay. And I think maybe those days are over. And so now we've got to revert to more of a long-term, patient perspective on holding real estate.
And as you see us everybody's talking about stability, so the further and further away from this kind of volatility that we had during the pandemic, are you seeing your sellers that are just kind of like, well, I guess I have to accept it's time to sell. I was kind of holding, but now I'm divorced, or I've got to move, or I lost my job, or I gained a job, or had another kid, or whatever the case may be. Are you seeing kind of life forces making those decisions for people more and more, or we'll start with you, Nova.
I don't think life forces have changed. I think life is going to life, and it always has, and it always will. So I don't see that there's any particular change there. I think the change, if anything, is that for a minute there, even when life was doing what life was doing, rates were so low and rents were so good and demand was so high that I had a lot of clients who would have ordinarily sold their house to then do their next step to suit whatever they needed to achieve. They would have sold to do that, but suddenly it was looking really good to hold, rent, and buy something new. Mm-hmm. So I think it has more to do with that. I think the further away we get from those lower rates, I don't have the statistic on the top of my head, but I just saw it came out from Realtor.com and about the percentage of loans beneath. Probably there's some lenders in the room who could shout it out, but the percentage of loans that are now below 4% has dropped quite a bit. And so we're seeing more and more loans are up in those 5s and 6s. And once that happens, that's where you have people who are like, all right, forget it, we'll just sell this and move on to the next project. So I think it's driven more by rates than anything else.
What about you, Britt?
I totally agree with Nova. I think the further we get away from the low interest rate days, the easier it is for sellers to make that life decision. I think they were sort of stuck for a while. They felt like they couldn't make that life decision, and it feels like it's getting easier. And likewise, if there's no perception that waiting longer, there's no more equity that's coming by waiting. And I think as brokers, we're going to be having a lot of those conversations. I've already had one this week where the folks said, oh, well, if I can't get X, I'll just wait a couple more years. I said, I'm not sure it's going to be that different in a couple more years. Maybe you outrun it. I've been wrong mostly for most years here, and it keeps going up more than I ever think. But I don't think, I think the days of, oh, I'll just wait another year and I'll get another 20% are not happening. And so to your point, just make the life decision.
Yeah, so talking about rates and mortgages, like I think there's some people being held in when they have that super low rate because they recognize like, oh my gosh, if I have to go buy another house that's maybe a level up, I'm going to be getting less of a house because my rate's not going to be remotely close. Can you guys tell me, I forgot to ask you earlier, what's the percentage of cash buyers you were seeing during the pandemic and what about since? Like where are we now?
So cash buyers have come back down a little bit. I think during the pandemic, I did a presentation like this actually a couple of years ago. So even post-pandemic, I think maybe it was in 2024, 60% of condo buyers at that point were cash buyers. I think that number now is in the high 40%. Single family homes have come down as well. There's always more cash in condos than there is in single family by about double. And so single families are down in the 20s and 20%, 25%. And again, I don't have that number in front of me, but somewhere around that.
But also just thinking anecdotally, your own clients, like,
Yeah, definitely seeing less. Personally, in, was it 2 years? No, actually last spring, we had, just on my own team, we had like 6 buyers in a row close cash. I was like calling lender friends being like, I haven't forgotten about you. I just don't, everybody's cash.
I don't need you right now.
Yeah. But it depends what market you're in and where you focus your activities. But I will say cash has started, the proportion of transactions that are cash. And I think that's a couple of reasons. One, people aren't feeling as bold as they were, when stock market gains were crazy. People were feeling really flush and really good. They were pulling things out. But now also as rates, they're like forgiving the rates. They're like accepting it now. And so people are feeling more like they would rather just, take out money than
What about you,
out.
Brett? I know. I want to take a couple questions. Okay. I just want to hear your answer.
I think we're probably fewer cash deals. We are starting to see some seller financing and more creative deals than we used to because you didn't have any of that when rates were 3%. There was no reason that the seller would finance for 3%. You just go to your lender and get the rate. So now that we're sort of hovering in the 6s, there's more incentive to do creative things. So yes, still some cash. That upper band of the nice investment properties, those are probably all cash purchases.
More, yeah.
But it's not a huge driver of the market, but certainly an aspect.
All right, cool. Anybody have any questions? I can keep asking. Could you come to the mic? Thanks.
Hi, one thing I haven't heard addressed today is down payments. Like you talked about a lot of younger people starting off are kind of reticent to buy their first home. And, in terms of financing, you have the main housing, first-time home buyers and other things as incentives. But I think a lot of the reason why some of these people aren't buying their own home is because they're having a tough time coming up with a down payment.
Yeah.
Any thoughts on that, or
Absolutely
have you heard anything?
Right. And I'll tell you, if it's a younger buyer, almost always they have family support on the down payment, in my experience. Not always, but almost always. The exceptions to that are sometimes out-of-state buyers, but yeah, a lot of parental assistance.
Yeah, but the same financing programs are out there and have always been out there. I mean, there's still FHA, and you can still buy a 3-unit, 4-unit with 3.5% down. I think we're seeing people start to move to the Lewiston Auburn market just because the absolute pricing in Portland, let's say, is just so expensive. The average 3-unit is $850,000. It's just a lot of money. So I think that is affecting the market some, but financing's still available. I mean, lenders are doing deals.
Great question. Thanks. Anybody else? Yeah, come on. Our favorite lender.
It's me. My name is Gwen Hewlett. I work for Bar Harbor Bank and Trust, and great to hear from you guys. I write residential mortgages for a living, and I always find, because the thing that makes me like, oh man, the conforming loan limit now in all 16 counties in Maine and most of the United States is now $832,750. So you can be a first-time home buyer and you can get a $850,000 house with 3% down, with like 49% of your total household income going to your housing payment. I'm curious.
49.999.
49.
What happened to 30%?
Correct. Is this kind of like historically, like, and that's like if you get a mortgage that's securitized with Fannie Mae or Freddie Mac. I'm curious if you guys, in your sort of conversations with folks, like outside of building more, right, which we need to do, we know about the units that we're really far behind on in the state and in the country. Like, are there other sort of tools that you see, like, our state being able to imply? Is it, I mean, virtually most of my pipeline is like younger families. They're trying to leg up, move. Like, what else can we do? Is it childcare? Is it, you know, I know there's not.
We have
like
all the answers to the housing crisis here. We just didn't want to tell you. We wanted to wait till the time was out.
Wait, but I'm like, you know what I mean? Like, I feel like we're just like wringing our hand. Like, it's so frustrating.
I guess I would just jump in and say, because we're almost at it.
Yeah.
We're over
We're
time.
actually over by a minute. But
I think the settling is we have built a lot. There are vacant units. I didn't talk a lot about the rental market.
Right.
There are vacant units. Now, there's still affordability problems,
Right.
but a little bit of it is it getting fixed. This is what it starts to feel like, right? The multi prices aren't going up because the rental prices aren't going up anymore, and suddenly there's a little bit of vacancy. Now, it's going to be a challenge. It's far from fixed, but this is the beginning of what it feels like. I mean, look around some of these towns. There are new units going up. So got a long way to go, but we're doing it. Most of the developers are here today who are out building these projects.
yeah, I would say the first part of fixing the problem is accepting that there is a problem.
Right.
And we've had to get through that. That was last year.
Yeah.
Now this year we're working on, especially with the legislation in session. But I'm sorry. Thanks, Gwen.
No.
A board member for MEREDA. Thank you.
No.
And
Thanks, guys.
I just want to thank Britt and Nova, and thank you all for being here. You don't have to move. They're going to pull the wall down, and then we're going to go into the next session.